Hi, everyone. I'm Sarah Beckett-Heil. I'm up here with a quick announcement. I'm just here to let you know about SQL Bootcamp. It's a 4-session mini course that's been organized by Professor Oken and Professor Bacchus. It starts this Friday in room 365 from 1:30 to 4:30 p.m. I really recommend anyone who's interested in SQL, is interested in learning to code a little bit, to come by and learn about it. It's completely free, and it'll be really helpful for anyone who doesn't have any experience in coding. We're going to sort of start from the beginning and work from there. If you want more information, it's kind of just easiest to Google the words SQL, NYU, and Bootcamp, because the very first hit is the website, the GitHub website that Professor Bacchus has up. And from there, you can scroll down and find all the information about the bootcamp and the course material that you can download. So that's it. Thanks, guys.
So how's the case coming? It's coming, right? Line item by line item, it'll build up. This too shall end. Right? So it's due a week from today before class. The reason is I will kind of spend about 30 minutes in class kind of taking you through the big issues in the case. And there are not that many big issues. So it needs to come in before the start of the class. It's electronic, so you don't need to send me a physical paper copy. Just you make sure that you send it to me, preferably as a PDF file, okay? Because it's easier for me to put my comments in. I will send it back to you. So very quickly, what you should do is after you've got it, so don't send me 15 Excel spreadsheets as attachments. I will not open any of them, I promise you. Okay? So put it together as a document, whatever format you want. Print it off as a PDF file. Save it as a PDF file. Send it with everybody in the group carbon copied. Because when I reply, I will reply all. So when you get the graded case back, you will all get it back at the same time. So you can get to see essentially what your grade is without having to check with me. Okay? So let's pick up where we left off. On Monday, we were talking about allocated G&A, right? That big number that shows up on project numbers when you do a project analysis. And we talked about how a lot of allocated G&A has nothing to do with the project. It's not incremental. Now, very quick detour. I mean, in my Disney example, I said 2/3 of the G&A allocated to this project has nothing to do with the project. It's fixed. So how do you know? I'll give you a very simplistic way. It's not a simple way. It's a simplistic way of figuring out how much of G&A is fixed and how much is allocated. And all it requires that you have historical data for your company on both revenues and G&A. What's the essence of variable? That it's varying with something, right? So let's assume I gave you 3 years of numbers, and I've intentionally made this a very simplistic example. Revenues go from $1 billion to $1.5 billion, year 1, 2, and 3. Okay? G&A costs that you see across that time period go from 250 to 7. So clearly G&A is growing with revenues. But I have a very simple question. Let's see if you can tell me what the answer to this is. How much of that G&A cost in year 3, which year 3 would be the 300 million, how much of that is fixed? Is there a way you can use the data to answer that question? How much of that cost is fixed?
You could baseline the percentage of G&A to revenues from year 1 and then any growth from year 1 to year 3.
Okay, so in this case, your revenues went from $1 billion to $1.5 billion, $500 million, and G&A went from 250 to 300 million, 50 million. So for every $500 million in revenues, G&A went up 50 million, right? Extrapolate that. In fact, here's the simplest way to think about a fixed cost. If revenues go to 0, what will G&A be, right? That's the essence of a fixed cost. And in this case, if I make revenues go to 0, and I said this is a very simplistic example, it'll work nicely here, might not work with a regular company. If I make revenues go to 0, guess what my G&A cost is going to be? Just extrapolate from those numbers backwards. My G&A cost is going to go from 250 million down to 150 million. Why 150? Because remember, for every $10 in revenues, I get $1 in G&A. So if I drop my revenues from $1 billion to 0, my G&A costs are going to drop by 100 million. So in this case, 150 million of the G&A is fixed and 150 million is variable. I know this is not going to work as easily if I gave you a regular company, if I gave you Disney's G&A for the last 25 years in revenues, but it's actually a very interesting way to figure out what costs are fixed and what are variable. I'm actually working with oil companies, I'm looking across oil companies now, to answer a very simple question. When oil prices change, how does it affect the operating income of oil companies? You're saying you need to do a study to find this out. I'll tell you. The answer is they'll drop. But I want to see why some oil companies see their operating income drop by less than others. And the answer, of course, is they have more flexible cost structures. They're able to cut costs. And the trick I'm using is exactly this trick. I have the operating income for 25 years for each oil company. I have the oil prices for 25 years. I'm trying to figure out, as oil prices change, how much the operating income is changing. That's going to give me a sense of how much of this is fixed and how much is flexible. And that's going to be critical for me to decide which oil companies to invest in. Okay? So use this as kind of a secondary tool, at least, to be able to answer questions: what's fixed, what's variable. So let's now move to the final step. So we've gone from earnings to cash flows to incremental cash flows. Last step in this process, we need to time weight those cash flows. Sounds fancy, right? I don't know whether any of you have any of your old finance books, if you took a finance class as an undergraduate. If you look at the very back of almost every old finance book, there's a present value table. Before calculators, that's how present values were calculated, right? Go to the table. And if you ever look at a present value table, here's what it looks like. It tells you how much a dollar is worth in 1 year, 2 years, 3 years, 4 years with different discount rates. That's what the table is. On top, you have the discount rate. And on the other axis, you have the number of years. So if you have a 10% discount rate, for instance, $1 today is worth 91 cents a year from now, 82, etc. So you'll see a dollar kind of taper off in value as you go further into the future. That's time weighting. The further into the future a cash flow and the riskier that cash flow, the less you're going to weight that cash flow. So when you're doing discounting, you're effectively time weighting. So that's what we mean by time weighted cash flows, is discounting the cash flows. Now, I know you are very fond of that present value function in your calculator, and I like it too. It saves you a lot of time. But I'm a little paranoid about these present value functions. I've never trusted the PV button on my calculator. I don't trust it in Excel. So call me old-fashioned. If you ask me to compute present value, I still do it the old-fashioned way. None of you have to match me on this because, you might feel more comfortable with your calculator. I still do it the old-fashioned way. This is every present value equation you will ever need in finance is on this page. Because there are only 5 types of cash flows you will ever run into. A single cash flow in the future, 100 million 10 years from now. Present value is 100 million discounted back, which is 1 plus the discount rate raised to the power 10. So that's a single cash flow. You could, of course, have an annuity. This is the payment button in your calculator. The present value button basically does this equation for you, but that's the present value of an annuity. Those two are already in your calculator. You're saying, why do I need these equations? I'm going to add 3 more equations that are incredibly useful in both valuation and corporate finance. The first is what's called a growing annuity. Let me give you an example of a growing annuity. You own a gold mine. It generates $3 million in cash flows last year. You expect those cash flows to grow 10% a year for 25 years, and then it all ends. There's no more gold left in the ground. I ask you, what's the present value of these cash flows? There's a long way to do it, right? Which is take 3 million, projected out 1 year, discounted back 2 years. So take each cash flow, discount it all back, add them all together. Present values always will work on an additive basis, but that's 25 different present values you have to compute. Or you can use this growing annuity formula. What will the numbers be? For the A, you would put in the 3 million. That's your cash flow. The G will be the 10%. The R will be whatever discount rate you're applying, and it'll be like magic. You can try this out if you want. You should get exactly the same present value using a growing annuity formula. If you have a programmable calculator, and some financial calculators are, and many scientific calculators are, you can program a growing annuity in, because it is that first leg in a valuation, a discounted cash flow valuation, is 15, 20, 25, 50% growth for the next 10 years. This will give you that present value. And then you get to the 2 most dangerous present value equations in finance. The first is a perpetuity. What's the essence of a perpetuity? What do you need for something to be a perpetuity? You need not just long term, it has to be a constant cash flow you get at regular intervals forever. Now do you see why it's kind of intimidating to use a perpetuity equation? Forever. So $100 each year forever is a perpetuity. The present value of a perpetuity is incredibly simple to compute. You give me what the cash flow is, $100. You tell me what your discount rate is. 100 divided by that discount rate gives you the present value of a perpetuity. So if your discount rate is 10% and you get $100 each year forever, the present value is 1,000. And actually the intuition is very simple. If you had 1,000 and you put it in the bank at a 10% interest rate and you left it there forever, what did you make as income each year? $100 each year. And if you find a perpetuity to be intimidating, think of a growing perpetuity. It's tough enough to think forever, but to think of something growing at a constant rate forever is kind of scary. But the present value of a growing perpetuity is always the expected cash flow 1 year out. This is like a present value trick you always have to remember. So if I ask you what's the present value today, you got to do the cash flow 1 year out. That becomes a numerator. And in your denominator is that differential between your discount rate and the growth rate. More mischief is done with this equation in finance than any other single equation, and you can see why. You're an analyst, you're valuing a company, you come up with too low a number. Relative to what? Come on, before you even sat down to value the company, you knew what you wanted to come up with. This is just an exercise in reverse engineering. You come up with too low a number, guess where you go to make your number go up? You go and you move G. A little bit, that's all you need, a little bit towards R. As G moves towards R, guess what's happening? Your denominator is getting smaller, your value is getting higher. And if you're not careful, you can keep moving G towards R until you get to Buzz Lightyear valuations. From Buzz Lightyear to infinity and beyond. That's where you're going, because that's what happens as G hits R. So we're going to talk about constraints on this equation, because if you don't have constraints, it really doesn't make sense. But those are the 5 equations that we're going to go back to over and over again whenever we want to time weight cash flows. So let's get back to the project. I have incremental cash flows, and I'd like to convert those incremental cash flows into a time-weighted measure of return. There are 2 ways you can compute time-weighted returns for a project. The first is the net present value. What is the net present value? Put simply, I take each cash flow discounted back to today, add up the present values of all of my cash flows, and I come up with a sum. That's net present value. And here's the simple rule. If that net present value is greater than 0, it's a good project, you're saying? But what if it's a $10 billion project and the net present value is $1? It's still a good project. Why is that? $10 billion project, why am I settling for a $1 net present value? That's one answer, but make it more specific. When I say the net present value is $1, what am I saying?
Because you have future earnings, so your discount rate might go down in the future.
No, we don't have to get that complicated. What's the essence of a net present value?
Because you're earning your hurdle rate already.
I am making my net present value by earning my cost of capital plus $1, right? That's the essence. It's excess value. Would you rather make $100 rather than $1? Of course. 100 million more than 100? Sure. You're saying, why am I settling for $1? Because beggars can't be choosers. Remember we talked about bad businesses? 55% of all companies do what? They earn net present values less than 0. Take a net present value of 1. I am celebrating if you're one of those 55 companies, because you just did a good thing. So I'm not saying I like net present values of $1. I'd much rather have $1 billion. But if that's all you can do, it's still a value creating project. So that's the net present value, and it gives you a dollar value. Lots of managers don't like NPV. And there's a simple reason. If I asked you what you earned on your investment portfolio last year, I might be hitting some sore spots, but let's suppose I ask you that number. Ask anybody that number. Ask Bill Ackman what he made last year. Your answer is never going to be a dollar value. It's going to be a percentage number. minus 31%, minus 23%, plus 15%. We tend to think, when we think in returns, of percentage numbers, and net present values are dollar values. So I have a solution. You prefer percentage numbers. There is a way you can compute a time-weighted incremental cash flow version of it. And here's what you need to do. You have those cash flows, right? You have a discount rate. Keep trying different discount rates till you come up with a discount rate that makes your net present value 0. There's one that exists out there. Get there. Once you get that, that's called the internal rate of return. Think of the internal rate. Remember we did return on capital, which was an accounting number. It wasn't time-weighted. It was earnings-based. Internal rate of return is the time-weighted incremental cash flow analog to return on capital. It's a percentage number, and all you do is you compare that percentage number to your cost of capital. So if your cost of capital is 9% and your internal rate of return is 9.2%, you've just taken a good investment. So NPV and IRR are both time-weighted incremental cash flow measures. Will they give you the same answer? Let's hold off on that question because we'll come back and spend a little time on it, not too much, on when the two might give you different answers, but they both come from the same base, time-weighted incremental cash flows. Yes?
For NPV, are you using the hurdle rate as your discount factor?
What else could we use? We're done, right? That's why, in fact, that's a good question. Yes, when I took corporate finance, I thought the sequencing was screwed up. We did capital budgeting first. We talked about cash flows, and we kept talking about discount rates. And I remember the class would say, well, what's a discount rate? Where is this coming from? And you'd make up numbers, 8, 9, 10, 11, 12. And then we got to cost of equity and cost of capital. We didn't realize why we're doing that. In fact, the reason we set the table with hurdle rates is without hurdle rates, you're up a creek without a paddle when you come to capital budgeting because you have nothing to discount with. That's exactly it. Which hurdle rate you use, we'll have to come back and talk about, but it's going to be based on a hurdle rate. In fact, in this case, we've already talked about, right? This is a theme park investment in Rio. The cost of capital is 8.46%. That's going to become our discount rate when we do the present value of the cash flows. One loose end I want to tie up. Last session, when we talked about accounting return on capital and we stopped after year 10, I started waving my hands and saying, you know what, the project is probably going to last a lot longer. Don't make your decision yet. But then I said I can't do much about that in the context of an accounting return on capital. That's true. But with cash flows, there is something I can do about the fact that the project might continue after year 10. Rather than end the project in year 10, here's what I'm going to assume will happen. I'm going to assume that Disney is going to keep the theme park going. For how long? Let's for the moment assume forever. I know that's completely unrealistic, but I'll explain why I'm going to go for the ever. I'm also going to assume that the number of tourists coming into the theme park will level off in year 10. I'll tell you why I'm going to make that assumption. But that Disney will be able to raise ticket prices at the inflation rate beyond year 10, which is not actually unrealistic if you look at Disney ticket prices for the last 25 years. So here's what happens. In year 10, the number of tourists level off. Why am I making that assumption? Because if I let the number of tourists keep growing as well after year 10, what's going to happen? You're going to go into the theme park and can't move. You come in, it's all crowded, so no place to go, right? So you can't be very careful about assuming real growth after some point, because unless you're investing in capacity to cover that real growth, that's patently unrealistic. So I'm going to assume an inflation rate of 2%, that cash flows beyond year 10 will grow at 2% a year forever. That's a growing perpetuity, right? I pull out the equation. The present value is the cash flow 1 year later. So to get the present value, the value at the end of year 10, I get to the cash flow in year 11 by taking my year 10 cash flow, 715 million, and growing it at the inflation rate. And then I divide by that 8.46% cost of capital I already have for the theme park, minus the 2%. I come up with this humongous value, 11,275 million. I'm going to call that my terminal value. What does that mean? There are two ways you can end a project. One is to get salvage value, where you shut the project down, liquidate everything, get whatever you can. That's salvage value. The second is to assume that your project continues, your company continues in for the long term. That's called a going concern or a terminal value. This is my terminal value. And it's built on the presumption that the theme park lasts forever, right? About a decade ago, I presented this to a group of managers at Disney. one of whom happened to be a theme park guy, and he put up his hand and said, I like the long life assumption, but no theme park lasts forever. I said, you're right. He said, but you're assuming that will last forever. And I said, okay, well, how long do you think a theme park lasts? He said, 50 to 60 years. I said, okay. I could give them 2% growth for 55 years. That's a growing annuity, right? I could tell you what the present value is. What do you think the present value is if I use a 55-year period instead of forever? It's 11.15 billion. When we use perpetuity assumptions, we do them constantly in finance. People often jump on you and say, but no company lasts forever, to which my response is, do a lot of companies last 50 to 60 years? If the answer is yes, we're quibbling about details that affect your third decimal point or second decimal point of the value. This is for convenience that we're making this assumption. It makes our present value a little simpler. So, yes, go ahead.
Well, does the idea that in reality it wouldn't be flatlined for
That's a different problem. Then you can put in can you put in a negative growth rate forever? You can actually. You can put in a growth rate below 0. The terminal value equation will still work. So if you feel that your company's best year is year 10, and it's in a business where it's going to shrink over time, you can actually put in a minus 5% growth forever. And what that'll do is, it'll peak your company in year 10, and it'll disappear, never quite go away, but it'll pretty much drive it into the ground within 10, 15, 20 years. So keep that option open of having a terminal growth rate less than 0. It's an option that I seldom see used, but it's an option we should use more, especially in businesses where we see decay and decline.
But then
Going.
the terminal value year has to be the peak year.
Well, yeah, if you want, or close to the peak year. Remember, there's some approximation I can let you get away with. So let's say it's year 10 rather than year 12. You stopped in 2 years ahead of your peak year, and you put in a negative. Since it's forever, the first 2 years kind of get drowned out by what happens afterwards. As long as you get close enough to your peak, you're going to be okay.
So if the peak might be 25 years,
Then you probably should push it out longer, because that's, if the problem is I am very wary of specifying peak years way out in the future, because let's face it, I can tell you it's a long time away or not a long time away, but it's very difficult to have a specific peak year unless it's connected to something outside, like a government contract that's going to run out in year 25. But you have that option. I think it makes sense to use that option more often than we actually do. So this is my terminal value. I'm going to bring it into my cash flows. So you ready? Second column are my incremental cash flows every year for the next 10 years. That we already estimated. Year 10, I put in the 11,275 million. I discount them all back at my 8.46% cost to capital. Why cost to capital? Because these are cash flows before debt payments. These are cash flows to the business. I discount them at the cost of capital. What I get as my net present value is 3.3 billion. Before we look at that number though, the biggest number by far in this DCF is the 11,275 million, right? Intuitively, you know what that captures? I know it's a present value of cash flows beyond year 10, but intuitively, what does it measure? Right, so that
Capturing the increasing returns.
and that's true, but we're still caught up in financial mechanics. You know what it captures though? It's if I sell this theme park, lock, stock, barrel, and Mickey included. You see why I've got to leave Mickey in there? Because if I, as Disney, try to sell this theme park as physical infrastructure with the rides, and I say, I'm pulling all the characters out, you're not going to pay 11,275 million. But if I'm willing to leave those characters in there and sell it to you, then you pay 11,000. There's no chance Disney will ever do that. So it's a hypothetical, but that's what the 11,275 million is what you think you can sell the theme park for as a going concern at the end of year 10 based on cash flows beyond that. Now I'm ready to draw some conclusions. You're ready. You're the decision makers. Why am I making your decision for you? I crunch the numbers. I put the net present value in front of you. Good project, bad project. Okay. Obviously, it's 3.3 billion is greater than 0. It's a good project. And here's, I think, one of the most magical things about NPV. When you take a project with a net present value of 3.3 billion, your value as a company increases by 3.3 billion. I see. What's so magical about that? Your value as a company is the sum of the net present values of the investments you take over time. So if you take investments with net present values of 0, year after year after year, what's happening to your value? Absolutely nothing. You could get to be a huge company. What happens if you grow by taking projects with net present values of minus 3 billion? Who would be dumb enough to do that? Hey, trust me, there are lots of companies that are dumb enough to do that. But your value is going to decrease by 3 billion. I'll give you an example. Last September, Royal Dutch Shell did an acquisition of a company called BG. It's a gas resource company for about 70 billion. They bought the company for 70 billion, which was a 50% premium on the market cap. So it was a publicly traded company. They did an acquisition for 70 billion. And of course, there was talk of synergy filling the air. The day the acquisition was announced, guess what happened to BG stock price? It went up about 50%. That's not the interesting side. On that same day, Shell lost 8% of its value. But you're saying 50 is greater than 8. They lost 8% of a $210 billion value. On the day of the acquisition, they lost $16 billion of market cap. Think about that, 16 billion. One decision. I'm supposed to be in Houston in a couple of weeks talking to the Royal Dutch finance team. And they're talking about things they can do to enhance value. Know what I'm going to tell them? You can work and work and work, creating 10 million in value here, 20 million in value here, and then your CEO goes out and does one acquisition. You're moving chairs on the Titanic after you've hit the iceberg. It's over. Big acquisitions are where you see these huge net present values left on the table. And that's the best way to think about acquisitions. And we'll actually use an acquisition as an investment, but when you overpay an acquisition, it is a negative net present value investment. So on a time-weighted incremental cash flow basis, this project looks good, right? Let's complete the story with time-weighted incremental cash flows. I want to compute the IRR on this project. Now, if I asked you to compute IRR on a project, what do? Go into Excel and hit the IRR function. In fact, many of you financial calculators have an IRR button and a yield to maturity button. I know, as I said, I'm not trustworthy on these issues, and I'm not trusting on these issues. I'm not trustworthy either. Right? So take that with a grain of salt. Right? So I prefer a different way of computing IRR. So I had those cash flows, right? I tried different discount rates. I started with 8, 9, 10. And as my discount rate climbed, my net present value dropped off. And I graphed out the net present values. This is called a net present value profile. It's not fancy. It's pure mechanics. Remember what I said? The IRR is that point at which your net present value is 0. Well, I can get this right out of the graph. It's right there. It's about 12.6%. Is that good? What do I compare that to? The 8.47% cost of capital. Again, you can't use IRR unless you've done a cost of capital. So for those managers that I like to use IRR because I don't need a discount rate, you're missing the point. They actually don't do net present value because they say you need a discount rate and a cost of capital. I can do IRR without a discount rate. You're right, you can get an IRR, but how the heck do you use it without something to compare it to? There's one small little issue that if you look at this graph, there's an interesting side benefit you get. Look at that graph. I can look at the slope of that line as I go through, right? What's the slope of the line measuring? How sensitive my net present value is to changes in my discount rate, right? Foundations of finance, did you use this concept of duration? What's duration measure? How sensitive bond prices are to changes in interest rates, right? Think of this as the analogous variable to duration. It measures how sensitive your project is to changes in your discount rate. So why would I care? But the 8.47% cost of capital I estimated. You had a risk-free rate in there. You had an equity risk premium in there. You had a risk premium for Brazil. Do those numbers change on a day-to-day basis? No. Every time the Fed meets, I freak out because there goes my capital budgeting from yesterday. Every time Brazil has another conniption, there goes my present value, right? And Brazil's having contractions, conniptions, seizures, all kinds of things going on. If you're concerned about your discount rate changing, in the world we live in, you should always be concerned. You know what this graph tells you? If I have two projects with roughly the same net present value, let's say I'm looking at two potential theme parks. They have roughly the same net present value of 3.3 billion, and one is more sensitive to changes in discount rates than the other. It becomes another measure of risk you might throw into the equation, saying, I would rather build my theme park in Cape Town, South Africa, rather than Rio, Brazil, because the net present value that I get is less sensitive to changes in my discount rates in my Cape Town example. So use the information. This is not just about extracting IRRs. There's interesting information you can get about your project from just looking at that graph. So let's close the process. I have a net present value for the project. It's 3.3 billion. Good project. The IRR for the project is 12.6%. Good project. Most of the time, when you're looking at standalone projects, the NPV and the IRR will give you exactly the same answer. What do I mean by that? When one tells you to take the project, the other will tell you to take the project as well, most of the time. You're saying, when will they not? I'm going to hold off on that question till excuse me, till next session. And next session we're going to come back and talk about when NPV and IRR might give you different answers and what to do if they do. But most of the time they will give you the same answer. Okay? And we'll talk about which one to trust based on those two. But for the moment, at least on this project, both are giving you the same green signal. Okay? Any questions on NPV or IRR? Now, all of this was based on a lie, right? Because I gave you all my cash flows in US dollars, a discount rate in US dollars, but the theme park is in Rio. All my cash flows are going to be in reais. I should have done everything in reais, right? So I have two questions. If I did everything, all my cash flows and discount rates, in reais instead of US dollars, should I get a different answer? That's the first question. It's kind of a normative question. Think like an analyst, right? If I got different answers using different currencies for the same project, I am in deep trouble, because exactly how do you explain your conclusion? This project looks good in rupees but not in dollars. How does a project flip from being good to bad? So we'd like them to give you the same answer. But let me ask you the pragmatic question. When analysts switch currencies from one currency to another, and they value a company or value a project, do they often get different numbers? All the time. And to see why that happens, we're going to dig into this project. So I'm going to try to convert this project from dollars to reais. Let's see what's involved. If I decide to do everything in reais, my discount rate and my cash flows have to be in reais, right? That's a consistency rule. What's causing, so when I go from dollars to reais on my discount rate, what explains the difference? Why am I going to get a different number? First, am I going to get a higher number or a lower number when I go from a dollar cost of capital to a real cost of capital? Higher? Okay. Why? The risk-free rate, but why is the risk-free rate higher in reais than in dollars? No, that's not the answer I was looking for. If it's riskier, then it can't be risk-free, right? So I've cleaned up for risk-free. So it is differences in inflation, right? And we talked about how to convert a dollar cost of capital to a real cost of capital. All you need to do is take the differences in expected inflation, in this case 9% in Brazil and 2% in the US, and my 8.46% dollar cost of capital becomes a 15.91% real. You're saying, this is horrible. My discount rate just went up by almost twice. So it went up from 8.5% to almost 16%. True. But now that I've decided to make my discount rate a real discount rate, my cash flows have to be real cash flows. All my cash flows are given to you in US dollars, right? To convert dollar cash flows to real cash flows, what do I need? I need an exchange rate. I'll tell you what you cannot use. You can't just use today's exchange rate all the way through time, because then you have a recipe for disaster. That's the first source of analyst problems. Is they say, I don't want to take a point of view on exchange rates. You just did through your discount rate. So here's how I'm going to get exchange rates. I'm going to draw on one of the oldest equations in exchange rates, which is the purchasing power parity theorem. Essentially, it says if I know the difference in inflation between two currencies, over time, my exchange rate has to reflect those differences. Let me get specific. When I did this analysis in 2013, the real dollar exchange rate was 2.35 reais to the US dollar. If I put in a 9% inflation rate in the US and a 2% inflation rate in reais, here's what I expect to happen to the exchange rate over time. I expect the real to weaken over time. Why? Because it is higher inflation, but roughly 7% every year. Actually, I showed this in Brazil towards the end of 2013, and I got a heap of trouble for doing it. They said, no way is this going to happen. Have you looked at the last decade? And during the last decade, the real had gotten stronger and stronger and stronger in spite of having higher inflation. They said that purchasing power parity, nobody believes it anymore. The real 4 reais to a dollar, that can't be. That's 1997 Brazil. You know what the exchange rate is right now? Is it below 4 again? It was up to 4.5 a few weeks ago. But 3.9? 3.5, that's not bad actually. I know that, so I would have expected to be 2.87. You're 3 years ahead of me, which is bad news in an exchange rate world. But ultimately, inflation will come into play. It's not today, it's not tomorrow. And what we're doing here is we're keeping our valuations neutral to exchange rates by building in inflation both into our discount rates and to our cash flows. It's those exchange rates that I use to get my expected cash flows. I don't know why it says Thai baht, but it should be nominal real. And I discount those cash flows back at the 8.46%. I'm sorry, that the 15.91% cost of capital. I get a net present value of 7.745 billion reais. I'm not quite done. If I divide that by today's exchange rate, because net present value is in today's terms, I get 3,296 million. Exactly the same net present value I got in US dollar terms to the nth decimal point. Now do you see why analysts end up getting different answers when they move from currency to currency? It's because they're making inconsistent assumptions about inflation in their numerator and denominator. You're saying, what if my inflation rate in Brazil is wrong? You know what? As long as you're wrong in the same direction in both places, you're going to be okay. It's one of the great equations in this process because it makes sure, it says, look, don't waste your time trying to finesse inflation rates. Just be internally consistent. Make currency a non-player in your big decisions as a company. Yes?
Where does the projected inflation rate come from?
The projected inflation rate comes from people's minds. Which comes from? Looking at the past. That's the first thing you look at. In the US, I don't have to read people's minds, right? The 2% inflation rate I can take by looking at what people are pricing a regular bond versus a inflation index T-bond. So right now that's like 1.55, 1.6%, and that'll become my expected inflation rate. In Brazil, it's a little messier because all you have is past inflation. Okay? You do have some inflation index bonds, but they have risk in them, so there's all kinds of stuff. So it's a little more difficult to get expected numbers. So what I do for Brazil is actually take last year's inflation rate or the average inflation rate over the last 5 years, because that's how we form expectations, is looking at the past. And as I said, as long as I'm consistent about building that same inflation into both my discount rate and my exchange rates, I'm going to be okay. Okay? But that's what we're looking for, is what's the expected inflation in this market. Yes?
Do you always use the same expected inflation?
Oh, you mean through time?
Yes.
You want to be tricky, you can, right? You can make it 9, 11 in year 2, but then your discount rate will also have to change over time. Did everybody get the question? I used a 9% and a 2% as my constant for the next 10 years. What if we expect it to be 9 and 2 for next year, 8 and 2 for the year after, 7 and 2 the year after that, 6? So let's say you expect that. Then your exchange rate will reflect those changing inflation rates, but then your discount rate will start at 15.91, but then over time it has to be stepped down as your inflation comes down. And since it's all going to even out, why make your life difficult? Just use that compounded average or something across time. Okay. Any other questions? Yes?
I have a question about how the change in inflation can affect the exchange rate. Given the, like, usually I have this fight with my managers because, like, they have the same idea of the exchange rate parity. But then what I was arguing is that most of the fluctuations in the exchange rate are by financial assets, and most of the inflation is determined by non-tradable goods between countries. So what is that?
Wait. What's the back? The second part of what you said? Inflation is determined by non-tradable goods.
Like, I'm from Mexico, and
Right.
like 80% 90% of the inflation is in goods that cannot be traded between countries?
That's not it, right? What's the biggest reason you have high inflation? When you get to really high inflation, there's only one reason. It has to be that monetary policy is out of control. We can talk about 2 versus 4 and talk about all the finessing issues. When you're talking about 12, 15, 20, 25, it's because you have a central bank that has absolutely no discipline, right? So if you're talking about small differences in inflation, you're right. There can be short-term. In the short term, I can't predict exchange rates. Nobody can. All kinds of things drive it. It's momentum driven, all kinds of stuff. But in the long term, the basis for purchasing power parity is very simple, right? Have you ever seen the economists used to have the Big Mac index? I don't know whether they still do. Where they used to see what the cost of a Big Mac was. I've replaced with my Starbucks cappuccino index, which is wherever I go, I order a venti cappuccino and I keep track of the price. And if the prices deviate, here's what I'm going to do. I'm going to fly to Vancouver and buy my Starbucks and fly back. That's, I think, the limitation is you can't equalize prices on things but if I had something big and you allowed me to move across borders to buy it, prices have to converge because I'm going to go to the lowest price. That's the basis for purchasing power parity. And you're pointing out, because of restrictions in being able to do that, you can have extended periods where purchasing power parity can be violated. But ultimately, the truth prevails, which is if you've been pumping up currency, your currency, and I'm not, eventually my exchange rate is going to reflect the fact that I have a disciplined central bank and you don't. And the exchange rates will reflect it. But it takes a long time. In project analysis, we're saying, look, in the short term, you can make money off exchange rates moving in the wrong direction. And if you want to do that, I'm not stopping you from doing that. I'm saying don't lock yourself into big long-term projects because you have an exchange rate view. That's all I'm trying to avoid here. Is I don't want Disney to build a theme park in Sao Paulo because it thinks the real is going to get stronger. That is a really bad reason to do it, right? If Disney had such a strong view on the real getting stronger, you know what I'd rather that they do? Take the $5 billion and buy foreign exchange futures. You think that's not their business? Well, that's what they're making their business if that's how they make investments. So you're trying to take it out of the process. Yes? Is U.S. inflation is what? Well, the dollar will weaken then. This is currency neutral. I'm not attached to the U.S. dollar. So what will happen then is it will be one. So let's say the U.S. inflation is 15%. It will be 1.09 divided by 1.15. So the equation remains exactly the same, but your exchange rates will then get stronger over time. So the equation is exactly the same always for the foreign currency versus the domestic. So I've given you my net present value. They were based on my expected cash flows and my discount rate, right? Lots of assumptions are made along the way about revenues, about expenses, about tax rates. And every single one of these numbers was an estimate, right? Every single one. There isn't a single number here which is a fact. And this is going to be true in almost all business analysis. This is not just true in finance. You start a business, you crunch the numbers, you come up with a number at the end. You should be uncomfortable. Why? Because you've been playing God for about 2.5 hours. And I remind you, you're not God. He said, really? You wake up to that fact? If you're not uncomfortable, there's something really wrong with you. Right? I mean, it's almost like a piece of... So it is natural when you value a company, look at the number and say, what if I'm wrong? That's a natural reaction. So I'm going to ask you some questions because this is something you're going to run into on the case. It's going to be something you run into on the jobs. You come up with a number at the end. Based on the most careful analysis, you're still going to be uncertain. So here are your choices. You can sit there and wait for the uncertainty to resolve itself. In which case, how long are you going to be waiting? So wait till China settles down. Okay. So let's say China settles down in 2 years. Guess what's going to happen? Brazil is going to rear its head. So wait till Brazil settles down. I mean, since 2008, how many crises have we had to wait through? It's once this is over, everything's going to be okay. So waiting for uncertainty to be resolved is never a good place for a company to be. And you know how many companies actually use that as an excuse for delaying decisions? We'll wait. We'll wait for QE to end. We'll wait for interest rates to bounce back. Yeah. The second is you can be risk averse and say, as long as there's uncertainty, I will never invest. In which case, you will have all your money in cash. You'll be a cash company. There is always uncertainty. The third is maybe you can shunt this off on somebody else. You can call in McKinsey and say, what should we do? They have no idea either. But this way, if something goes wrong, you can blame McKinsey. McKinsey told us to build a theme park. How often do you hear this from companies? I'm sure when I go into Shell and talk about that $70 billion acquisition, you know what they're going to tell me? But the investment bankers ground through the numbers and said me this was a good deal. Most of the time, we hire consultants for one reason and one reason alone. It's to pass the buck. It's to blame somebody else if things go wrong. Or maybe you are one of those very special people who's unfazed by uncertainty. There are actually these studies that show that traders and psychopaths, I'm not saying traders are psychopaths, when you do pictures of their brains, have this one part of the brain, kind of an abnormal missing part. You know, gamblers too have it, which is this emotional part that leads you to do crazy things. That's gone. That's what makes for a great trader, is they can be completely unemotional in the midst of lots of emotion. It's the same thing that allows psychopaths to do what they do as well. Which means be glad when you see a trader. Be glad you chose trading, because the alternative is much worse. Right? So maybe you're one of those people who says, I don't care. I cannot ignore this. I cannot pass it on. I have to make decisions. I'll give you some of the tricks you can try to make yourself feel more comfortable about the number you have. The first is, remember what's troubling you about this investment is it's a big investment, right? $5 billion, and you're worried that it could go back. Wouldn't it make you feel a little better if I told you could make your $5 billion back and then have to worry about returns? This is age old. As long as you've invested, this is called payback. How many years will it take me to make my money back? It's not enough, you know, but at least if you can make your money back, then everything else is icing on the cake. You can even do a discounted payback where you ask for your money back plus the 8.46% return. I'll give you the numbers for this particular theme park. It'll take you about 10 years to get your money back. It'll take about 17 years to get your money back with a fair rate of return. What are you going to do with those? There are companies that actually put in payback constraints. They will take projects only if the payback is less than 6 years, 5 years. I know a lot of real estate developers who will not invest in a real estate property if the payback is greater than X years. That's not as laughable as it looks like. So you're saying, that's so unsophisticated. It doesn't matter. It's their way of saying, you know, I need to be more careful about getting my cash back from my investment, and then I can worry about the good stuff. So that's the oldest technique for dealing with uncertainty. Here's the second. You can ask what if questions, right? What if this, what if that, what if that and that? And I'm going to make a statement that's going to sound incredibly odd. It's become too easy to ask what if questions. Relative to what? I did my MBA from 1979 through 81. Summer of 1980, which was when I was looking for a job, was a deep recession year. No jobs to be had. I finally found one with a company called Watermark. Company I'm sure you've never heard of. It was a private business. It had one product. A radio show it produced and syndicated. The way it works is you make your radio show, you sell it to radio stations, they pay you $1,000 a week for the show. In fact, some of you might have heard of the show. It's still on. It's called American Top 40. If you've ever driven through the country on a Sunday, it's this incredibly creative concept. Here's how it goes. It's a 4-hour show where they start with number 40 and they work down to number 39, number 38, and between the songs they give you a little pitter-patter about gossip, etc. Right? It used to be, the DJ who did the show was a guy called Casey Kasem, legendary DJ. Now, of course, I think it's Ryan Seacrest, I think, who's the DJ. Right? But that time, that was their only product, one show. They sold it to almost 425 stations each week, $1,000 a week. So it was a pretty lucrative cash cow, $425,000 every week for 52 weeks. So they called me in because they wanted to do a second show called Soundtrack of the 60s. But this is 1980, so guess what they were going to do? Go back 20 years to 1960, pick the same week and do the top 40 countdown. Incredibly creative twist on the original one. But this was their version of oldies and goodies. We want older people listening, so and they hired me to do the analysis of the show. I had done one corporate finance class. I thought every project came with cash flows. At least it did in the textbook, right? It says year one, this is the cash flow, year two. I remember walking in the first day into this company, a small company, everybody at a cubicle, including the CEO and the CFO. I walked into the CFO's cubicle and I said, I want the cash flows. I've been hired to look at the show. He gave me a ledger book. Have you ever seen ledger books? These are these books with the columns already pre-drawn for you. That was the big innovation. You didn't have to draw the columns yourself. There was nothing there. And I said, it's blank. I said, yes. You're going to fill in the blanks. So I started by putting year one, year two, year three. That's the first row, so I could do that. After that, I was kind of stuck. I said, what do I do now? I know nothing about radio shows. So I went to the marketing manager's cubicle, and he hated me. He absolutely hated me. He was a creative guy, and I was a numbers guy. And if you've ever been around creative people and numbers people, you know the oil and doesn't mix. He acted like I wasn't there. For about 3 days, I hung out outside the cubicle. He just walked by as if I wasn't there. Finally, at the end of the third day, I decided I need some numbers. I said, you know what? I need to get started. How many stations do you think you can sell the soundtrack of the 60s to? He said, I don't know, 100, 200, 300, something like that. I said, okay. That's all he's going to give me. I went back to my mini cubicle and started the column going. In my base case, guess how many stations I used? He said 100, 200, 300. I went right down the middle. Extremely logical, right? 200. I built the entire ledger sheet based on numbers like these. Throwaway numbers that people gave me because that's all they would give me. It took me 6 weeks, and at the end I was done. I had cash flows for every year. I don't even know how I came up with the discount rate. And then I came up with the net present value. I was so proud of myself. So I tell the CEO, look, I'm ready to present my findings. So 3 guys gather around a coffee table with me. And I present my findings. It's 2 directors and the CEO. So I go through the assumptions, and at the end, I hit them with a climactic moment. Based on my analysis, the net present value of this project is negative. You shouldn't do it. They look at each other and say, what would happen if you tried 300 stations? Remember, this is an Excel spreadsheet. Change 200 to 300. Every single number on that sheet I did by hand with a calculator. It wasn't an abacus. It wasn't that long ago. And I have to go back and redo it. What if questions then took forever to answer because they had to be answered manually. And I remember asking, why do you want me to try 300? They said, will that make the net present value positive? I said, probably. He said, then we'd like you to try 300. I said, why? He said, we've already decided to do the show. We just want you to confirm it for us. I said, you hired me to confirm a decision you've already made? At that time, I thought it was because they were a small business and not being scientific. But I'll tell you what I've discovered after 35 years of being in this business. In most decisions, the decision gets made first, the analysis follows. People decide what to do, then they go looking for justification for it. But today, asking a what if question, trivial, right? Sit there with Excel, try this. You like writing macros, you could probably have it run Excel scenarios through the night. Every year when I give out this case, it's a different case each year. The one thing I beg people, and I'm going to beg this of you, is please keep it short because I've got to read all your case analyses. If you're writing more than 4 pages, I don't know what you're writing about, but stop. Okay? There shouldn't be much writing to do. This is about decisions, so don't go on in the strategic BS trip of the one hand and the other hand and the third. I don't care. Just decide, tell me what your decision is, I can live with it. Right? And most of the time groups listen, but about 2 years ago I remember getting these case analyses back. Everybody's 8, 9, 10 pages, because of the exhibits it's another few pages. And then there's one case which is 110 pages. I pick it up and say, what the heck did these guys do? Start browsing through. They've run 105 different scenarios. The case. Scenarios like, what if Janet Yellen catches a cold? Net present value shifts. Here's the net present value. 55 the scenarios, they got a positive net present value. 50, they got a negative net present value. Remember, your mission is, will you take the investment? So they get to the last page to tell you what to do. So here's what they say. If you know you're going to be in a positive scenario, take the project. If you think you're going to be in a negative scenario, don't. We're too confused, you make the decision. And you know what? In lots of what-if analyses, that's where you end up. It's 8 o'clock in the evening, you're finished with the analysis, you feel pretty good about yourself. Then some idiot in the group says, let's ask what-if questions. At 11:30, you look at what you're doing and say, I am completely confused. More confused than I was 3.5 hours ago. Don't forget the end game here. If you're going to ask what-if questions about something, it's because you want to make a better decision. Which means if you're going to ask what-if questions, keep it focused. Keep it on 1 or 2 variables. Don't do it on everything. Preferably variables that you have some control over. So don't ask what-if questions like, what if interest rates go up? Okay, what are you going to do about it? It's going to affect everything you do as a business, so focus on the things you can control. And when you present your results in what-if analysis, don't churn out table after table after table after table. Because as I promised you, I'm not looking at all those tables. So if you have 15 different tables with 15 different scenarios, I'm not that interested. Find a way to summarize what your what-if is telling you from a decision-making process that's changing or leading to reinforce your decision. In fact, I think one of the biggest problems with Excel is insert chart is so close to you. You feel this urge to insert a chart. You have 2 numbers, insert a chart. You get two big columns next to each other. You can make them 3-dimensional columns, I guess. But if you want to show me 100 and 120, just telling me that revenues went from 100 to 120, I kind of get it. It went up 20%. I don't need a graph to bring it home. So I'm going to give you my favorite reference for graphing, because this is my struggle constantly, is how do you present numbers in a way that people don't drown in numbers. And it's a book by a guy called Edward Tufte. Tufte is his last name. He's, I think, in Princeton or Yale. He teaches about, his specialty is the visual display of information. And in this book, in that book is my favorite graph of all time. It's 150 years old. It was drawn, hand-drawn by a historian who was trying to explain Napoleon's ill-fated expedition to invade Russia in the 1800s. So here's how it begins. Napoleon wakes up one day and says, I'd like to invade Russia. What this fixation with Europeans with invading Russia is, I don't know. It's big, it's out there, I guess you want to invade it. So he gets up and says, I want to invade Russia. Big French army gathers together. There's the army leaving. So the width of this column is the size of the French army leaving Paris, ready to invade Russia. So there it is marching through. You're saying, what are these little things? He gets distracted. He invades Poland along the way. All these countries along the way. So let me... But he keeps marching, and he's saying, why is this bar getting smaller? Russia is a big country. It's not like walking from Paris to Luxembourg. This is Paris to Moscow. So he gets the outskirts of Russia. He keeps going and going and going and going and going. He gets to the outskirts of Russia, there, Moscow. December 15th. Ever been in Moscow, December 15th? Don't go there. That's not a good place to be, December 15th. That's exactly the reaction Napoleon had. It's cold. I want to go home. In fact, if you go to Moscow, there's this big gate where they're very proud about the fact that that's where they stopped Napoleon. The reality is, you didn't even need any people. The weather stopped Napoleon. He stopped at the gate and said, I'm going back home. So there's the French army going back. That's the black column. And in the other axis, you're seeing the temperature drop as he goes back to Paris. So look at the size of the army. There it is, back in Paris. 3 guys carrying Napoleon home. This is a great graph. The entire picture is right there in one graph. All you have to do is show me what will happen to your net present value as margins change. That should be a much more trivial exercise than showing when Napoleon failed to invade Russia. But if you get a chance, this book is a paperback now. You can get it on Amazon for less than $10. Browse through it. It's a great way of thinking about presenting information because it's a huge skill to have if you can present information in a creative way. There's one final technique I've increasingly turned to because the tools are at my disposal. When I did my Disney base case, I gave you numbers, right? I gave you revenues for the theme park based on my estimates. I gave you the fact that expenses at those theme parks would be 60% of revenues based on what I saw in Disney World and Disneyland. I gave you a cost of capital based on a 3% risk premium for Brazil based on what I knew in 2013. But they're all estimates, right? And if you think about enriching your estimates, rather than give you one number, what if I could give you a distribution? You say, what does that mean? Instead of telling you what the revenues would be, what if I gave you a range on revenues? Say it could be 20% lower or 20% higher than what I've given you. That's probably realistic because I really don't know. What if instead of giving you a 60% expense ratio, I said it could be as low as 48 or as high as 72? I could base this on my history. I could look at the numbers in Euro Disney, Tokyo Disney. And then for the cost of capital, instead of giving you one risk premium for Brazil, I said, look, based on its history, that premium could be much higher or much lower. And I said it could be anywhere from 4.5%, 5% to 2%. You're saying, how does that help me? You know how a simulation works? In a simulation, here's what you do. You go pick one outcome out of the first distribution, out of the revenue distribution. What could you get? You might get a number much higher than your original estimate and much lower. Let's suppose you got a number. Then you go to the expense ratio, pick a number. Instead of getting 60, you might get 71. Then you get to the risk premium and pick a number. You get a different risk premium, different cost of capital. You compute the net present value. Then you do it again, and again, and again. Obviously, if you're doing it by hand, there are only so many times you can do it. It's lots of work involved. I don't know whether any of you have used the crystal ball add-on that almost every Stern, I think all the computers here have it. If you have Excel, crystal ball is an add-on. It's a little menu item. Most of you probably don't even notice when you open it. And what it allows you to do is take a cell in Excel and make it into a distribution. What do I mean? Revenue growth. If it's normal Excel, you have to enter a number, 8%. If you have crystal ball installed, instead of entering a number, you can say the value for revenue growth is normally distributed with an expected value of 8% and a standard deviation of 3%. And then crystal ball goes to work on the simulations. Its default is 100,000 simulations in 1 minute. It's like magic. You actually see the graph show up. Because here's what the output looks like. Instead of giving you one net present value, I'll give you a distribution of net present values. The median across the distribution is about the 3.3 billion that I got in the base case, but no surprise there because my expected values were the same. But here's what you learn in addition. What are you worried about? It's a big project. It could be a bad project, right? I could count the number of net present values less than 0 and say there's 11%, in this case, a 12% chance that your net present value could be negative. Use it wherever you want. I could give you your best case, your worst case, it's in there. Instead of running a dozen scenario analysis, it's all there because it's captured in this distribution. It's an immensely powerful tool that 25 years ago you'd have had to spend millions of dollars to use. Today, if you go to the Oracle website, you can download Crystal Ball for free. And the good news is you get a student discount while you're still a student. It's like $150 to get Crystal Ball. Once you graduate, it's more like $700 or $750. But it's still really worth it, no matter, even if you're never going to be in finance. If you're in any kind of business that involves, where there's uncertainty. And I can't think of too many businesses where that's not true. This is a great tool to bring richness to your analysis. The only caveat is, the first time you use Crystal Ball and you go to a cell, it's a revenue growth. It'll offer you 53 different distributions to pick from. I hate to be cynical, but statistics classes pass through us without leaving an imprint. In fact, if I ask you what's the only distribution you remember from your statistics class, the honest answer is the normal distribution. So you say Bernoulli distribution, you say, what the heck is that? Never heard of it. Exponentialized sounds too complicated. Log normal, no. Normal, I'm normal, I'll pick normal, I'll keep going. It's amazing how much Monte Carlo simulation, everything is normally distributed because that's the only distribution we're comfortable with. If you're interested in doing this, and don't do this for the case, please. You don't have the data to do this for the case, but if you're interested in doing it, I have a paper on my website on how to pick distributions. Basically, it lays out the distributions in a picture and says, these are the kinds of distributions you should pick for these variables. But try it out because it's a great tool to add richness to your analysis. So all of these are designed basically to make you feel more comfortable with your decision. So in this case, for instance, by doing the simulation, I haven't changed the net present value. But I've added this chance. There's a 10% chance, 12% chance your project could be a bad project. The decision is up to you. As a manager, you might say, well, you know what? Nothing I can do about it. I'll accept the investment, print the results, put it in a folder. So if anybody asks me whether I did due diligence, I can pull the scenario analysis, the simulation out. The second is you might say, look, as long as there's a 10% chance the project could be bad, I will not take it. In which case, you're coming dangerously close to double counting. Why? Because we needed the net present value. What discount rate did you use? A risk-adjusted discount rate. Now you're using risk again as kind of a crutch to say, I won't take it. So I'd be very cautious when people use scenario analysis or simulations to reject a project that has a positive net present. So you're saying, why are we doing it? I'll tell you why I like scenario analysis. Because especially if you're managing a business, it tells me the variables that drive my value the most. In the case of Disney, let's assume it's a number of tourists coming to the theme park. You know what I'm going to keep track of every day if I open this theme park? Is how many tourists are coming in. And if they're not coming in enough, that's what I have to work on because it tells me where I need to focus my attention as a business to make this project into a good project. Okay? So any questions about what if analyses, simulations? So try it out. As I said, Crystal Balls is on Excel and you can work it out. So I'm going to now move to a second project. And this is going to be a much simpler finite life project. It's a new iron ore mine that Vale is considering opening in Canada. Okay? So this was from 2013. And I'm going to do everything from an equity perspective. So just to show you how that perspective is different than what I did at Disney, I'm going to use an equity perspective. What does that mean? When I look at accounting returns, I'm going to focus on return in equity, not return on capital. And I'm going to compare the return equity to the cost of equity. When I do my net present value, I'm going to focus on cash flows after debt payments. Cash flows to equity, discount them at the cost of equity, and compare to the equity investment in the project. So it's going to look very similar to the Disney analysis, but there'll be subtle differences. And I want you to focus on those differences. So let me describe this project. This is going to be a mine, as I said, with about 8 million tons of potential iron ore that they're going to take out each year. The mine's going to take a little while to kick in. It's going to cost $1.25 billion. It's going to be a 10-year mine. It's a finite life. So there's no playing games with perpetuities there because there's only so much iron ore under the ground. At the end of the 10th year, you're going to get a salvage value of $250 million for whatever's left. Okay? So you're going to have iron ore production kick in. The price, when I did this analysis and watch it and look at it and weep, because if you're a Vale investor, this is what's killed, or partly what's killed Vale over the last 3 years, is the price per ton when I did this was $100 per ton. That is now down to about $38 per ton. You're saying, how come you didn't see that coming? I didn't. If you did, there's a lot of ways we could have made money. Why don't you just let me know, right? So are you the $100? And I'm going to assume when I did this, it's going to keep pace with inflation for the life of the plant. Variable costs are going to be $45 a ton. There's a fixed cost. The costs will all be in Canadian dollars. But here again, at the time that I did this analysis, I had this nice convenient exchange rate. It was 1 Canadian dollar to 1 US dollar. It's no longer true. It's now about 0.89 US dollar to a Canadian dollar, but it was 1 to 1. And because inflation rates were close enough, I kind of left it at 1 to 1. Working capital requirements are going to be 20% of revenues, and they have to be made at the beginning of each year. So who cares, beginning or end? It's going to affect the timing of the investment. Vale's corporate tax rate of 34% will apply to this investment. So here's what I'm going to do. I'm going to do exactly what I did for Disney, but from an equity perspective. Okay? Before I do that, though, one more thing. Because I'm looking at an equity perspective, I'm going to have to add something I did not do for Disney, which is be more explicit about what they're borrowing. And in this case, they're actually going to borrow $500 million out of the $1.25 billion using a term loan. You know what a term loan is? A typical mortgage loan is a term loan. You borrow money and you pay off the loan in equal annual installments or equal monthly installments. In this case, you're going to pay off the loan $61.8 million every year for the next 10 years. The $500 million gets paid off. But every year, that $61.8 million I break down to how much is interest and how much is principal. Early on, you have a lot of interest, not very much principal. Later on, You have less interest because as you go through the loan. Why do I care? If I'm going to, this is cash flows. Why do I care how much of the 61.8 is interest and how much is principal? Yeah. Taxes and interest is tax deductible, so I have to separate the. Now do you see why doing equity analysis is a little more tedious than doing firm analysis? Because I have to break it out because the two cannot be treated equivalently. So here's the first thing I did. I tried to project out the equity earnings on this mine. Equity earnings, not operating earnings. So here's what it's going to, oh, I need a discount rate before I do any of that, right? I'm going to do this analysis in US dollars. I'm going to do everything from an equity perspective, and it's an iron ore mine. You're saying, why are you telling me all of this stuff? Remember I had all these numbers I estimated for Vale, where I had a cost of equity and a cost of capital for different businesses. This is an iron ore mine, and I'm going to use a dollar cost of equity, not a real cost of equity, a dollar cost of equity, because I'm doing everything in US dollar terms. So what you're going to see as my discount rate is 11.13%. So again, the reason I used the cost of capital for Disney is not because it's the only discount rate, but because I was using cash flows before debt payments. Here I'm going to be looking at equity cash flows. My discount rate has to reflect that. It's going to be 11.13% cost of equity. So here's my earnings. Don't even try to read this page. It's too let me tell you what I did. I started with the revenues on the mine, and that reflects how much I'm going to sell each year. So as the mine ramps up, my revenues go up. I have to multiply the number of tons of iron ore produced by an expected iron ore price, which I've assumed to be today's price of 100 growing at the inflation rate. Hopelessly unrealistic in hindsight, but at that time, the best I could do. I subtract out my variable costs, which are 45% of my revenues. My fixed costs are going to be 125 million growing at the inflation rate, so I subtract those out. I also subtract out depreciation and interest expenses. With Disney, I never even thought about interest expenses because I was looking at pre-debt cash flows. Here I subtract out the interest expenses. That gives me my taxable income. I net out my taxes, and as with Disney, I'm assuming there's income elsewhere to protect me. There's my net income. Net income and operating income are not interchangeable words. I know it's stating the obvious, but I want to be very, very clear about this. Net income is to equity investors. Operating income is to the entire business. So when I look at net income, I'm looking at equity income because that's what I want to stay focused on. And because I'm equity focused, when I do my book value, in addition to doing the book value of the mine, which I have, I subtract out the debt outstanding from it because I want to get a measure of how much equity do I have invested in this mine. So it's a mindset change. When you do everything from an equity perspective, you don't care about the bank, you don't care about borrowers, all you care about is what am I getting out of this project as an equity investor, what am I investing in this project. So if I do the return on equity for this particular mine, not the return on capital, net income divided by book equity, I get a return on equity of almost 31%. My cost of equity is 11.13%. Just a note of warning, when you do returns on equity or returns on capital in finite life projects, you know what's going to happen to your return on equity and return on capital as the project gets older and older? It's going to go up because you're writing off. It's a given. So if I have a lot of old assets, they will tend to have higher returns on equity and returns on capital simply because I'm depreciating it. You say, why didn't that happen with Disney? What did I do in the Disney case that prevented that from happening? What was the item I put in which is not here? Capital maintenance. Remember, I made you put money back to preserve it, and part of the reason I'm doing it is if I don't do that, I'm going to run the book value into the ground. But at least on an accounting return basis, this project looks like a good project. Any questions on it? Yes?
Because the tax impact of debt changes the cash flows, why do you have to worry about the debt equity
We do it through the cost of capital, right? Because in a cost of capital, what do? I include the after-tax cost of debt. So I give you the benefit in the discount rate there. Here I do it through the cash flows. Okay? Think of what will happen if I did not have the tax benefit. My cost of capital for Disney, instead of being 8.47%, would have been close to 9%. So by having the tax benefits already embedded by having a lower discount rate, And that's why I don't need to count it in my cash flows.
Sorry, does it then assume a certain split?
Exactly. In fact, I kept the debt ratio constant over time. So if you'd asked me to show the debt in the Disney theme park, I'd have had to show you $1 debt each year, which would change as the theme park aged. Okay. So that's my net income and return on equity. Let's make this into a cash flow. Okay. Incidentally, remember how we did returns on capital for companies and compared them to cost of capital, that graph I showed you? You can do the same thing with return on equity and cost of equity. But return on equity is always a more dangerous number than return on capital, simply because we have a highly levered firm. Think of what your return on equity is going to look like. In good times, it's going to be 100%. In bad times, it's going to be minus 80%. Everything gets magnified. So I tend not to get as focused on return on equity as I do on return on capital. But measure it anyway for your company just to see what it's doing collectively on the book equity that it has invested. One caveat though, some of your companies could end up with negative book equities. And that can happen if you lose money for a long enough period, in which case return on equity becomes not meaningful. So don't divide a positive number by a negative book equity. I'm not even sure what that measures. So to get to cash flows, I have the net income. Here's what I need to do. I need to add back depreciation and amortization. I need to subtract out capital expenditures. I need to subtract out change in working capital. So far, those three adjustments were the adjustments I made when I did cash flow to the firm. But the last adjustment we did not make in the cash flow to the firm was here I have to worry about debt payments. Why? Because I'm an equity investor. I have to pay off the loan. That becomes a cash outflow. And in the year 10, because the project ends, I've got to mop up. Mop up in what sense? That $250 million that I have as salvage value now becomes a cash flow I can collect. And all the working capital I've invested in over the next 10 years, I can't leave hanging out there. I don't throw inventory out in the streets. I'm going to sue myself for cost. Not at the regular price, but at cost. And that's what you see as my salvage value working capital. So if you have a finite life project, make sure you don't leave stuff at the end, untethered, because that all has to be taken care of. So those are my cash flows. Those are cash flows to equity. You discount them at the cost of equity. The net present value that I get for this project, cash flows, equity, in US dollar terms, so I use 11.13%. NPV for this project is $304 million. Good project, bad project? Well, based on the NPV, it's a good project, right? And why is it a good project? Because iron ore prices are at $100. So let's do a what if. And I did this at that time. I said, what if iron ore prices are different? And I'll jump the IRR. So I'll come back to these. If you look at changing the iron ore prices, obviously iron ore prices drop, the NPV drops. In fact, the break-even price for the NPV is about $75. It's at 100, so I have a lot of, it can never drop from 100 to 75. That'll take so long. It's been facetious, but it could happen. And the other number that is driving this is all my mines are in Canada, right? My costs are in Canadian dollars. My revenues are in US dollars. So if exchange rates change, I'm going to be hurt. In fact, if the Canadian dollar becomes weaker, my present value actually goes up. Why? Because my costs are all in Canadian dollars. This is actually one of the few benefits Brazilian companies are getting right now. If their costs are all in reais and their revenues are in US dollars, their costs just went down, right? But if the Canadian dollar gets stronger, you can see again, net present values can actually become negative. Everything else being held constant if the Canadian dollar becomes 18% stronger. So there are macro components to this net present value. If iron ore prices change a lot and exchange rates change a lot, and that's stating the obvious. This is going to be true anywhere. So I'm going to leave you with this final question, and I'd actually think about it. You could, as a commodity company, go out and try to protect yourself against commodity prices, right? You can lock in futures contracts. If you're Vale, should you be locking in iron ore prices using futures and options market? No fair, using the benefit of hindsight. It's like, of course. Let's say it's $100. You have no idea what's coming. Should commodity companies hedge output risk? It's a fundamental question they're all facing right now. Should they hedge output risk? Or when should they hedge output risk? Because I think there are conditions under which you should hedge, and lots of conditions under which you should not. Should you hedge output risk? Anybody own shares in oil companies? No? Who do you own shares in? Oh, okay. So, Petrobras. What do you want to punish yourself or something? Okay. Petrobras is kind of a messy example, so I'm going to take it off the table because you invest in Petrobras for lots of different reasons, including will the president resign? Petrobras goes up 25%. I'm invested in 2 oil companies, one of which I'll pick. I'm invested in ExxonMobil. Why am I invested in ExxonMobil? Because I love the way it's managed. I don't even know who manages it. Frankly, I couldn't care less. I invest in ExxonMobil. I bought it just recently because I think if oil prices will start to go back sooner or later. And I'm investing in ExxonMobil because I want to benefit from oil prices going up. Do you see where I'm going? If I invest in an oil company and you go and hedge your output risk, and oil prices go to 65, and I'm doing a little dance in my house saying, I picked the right stock, and I look at your earnings, what am I going to see? Nothing. So what happened here? If you're an oil company, I invest in you because I want to make a play on oil. If you're a gold mining company, I invest in you because I want to that's actually why you should be very careful hedging output risk. But I'll tell you the one place where you might want to hedge risk. If you're an oil company with a lot of debt, you see why you might want to hedge risk? Even if you believe oil prices are going to go back eventually, what's the problem you face? Eventually is a long time away, right? If you don't make it to eventually, then I don't care if oil prices go to 75. That's the one place where I think it makes sense. If you're levered and you're worried about default risk, you have to start hedging. And the other thing I want you to think about is exchange rates are the most hedged risk on the face of the earth. I want to talk about is, are companies doing the right thing, going out and hedging exchange rate risk? And again, I'd like you to think about under what conditions should you hedge exchange rate risk and what conditions should you not? And if you want a framework, use the page on the next page because I kind of take you through the questions to do that. Next class, we will start by looking at this page and using exchange rates specifically to try to answer those questions. Yes?
Would you consider discounted payback somewhat similar to duration then? Insofar as it's the time that you match?
The only difference is duration. Duration measures how as discount rates change, the present value changes.
Right.
Discounted payback just keeps the discount rate fixed. So it doesn't allow for the dynamics of discount rate change. It's driven by the same fear, which is, what if I don't make my money back, right? So I think that they come from the same source, which is uncertainty about the future, but I think they're worried about different things. With discounted payback, you're saying, what if I don't make my initial investment back? With duration, you're asking, what if discount rates change? Yeah.
Came up in a real estate class. Do we see that even though real estate assets are not marked to market on balance sheets, that they're accurately reflected in stock prices? Like if a company were to acquire or sell,
it depends, right? It depends on
asset.
what kind of company is it? Is it a real estate
for example,
company?
not real estate companies. So the New York Times own the New York Times building, right?
It won't be
and then they
reflected.
sell it.
It won't be reflected.
It's not reflected. So the New York Times owns
Because when I value the New York Times, I value it as a newspaper, right? So let's say its value as a newspaper is $1 billion. The value of the Times building is $3 billion. Let's make it extreme. I have to value it $1 billion because the New York Times family is so locked up in running the New York Times that they're not going to convert to real estate. If an activist investor targeted the New York Times, then I'm more inclined to say I'm going to go with a $3 billion value, because part of the reason he's targeting the New York Times is he thinks he can buy the New York Times, sell the property and maybe even lease it back, or maybe move the New York Times staff to some other cheaper location. But to make a blanket statement, market values already reflect real estate values would be a very dangerous thing to do.
So how about if non-real estate companies sell valuable real estate assets?